This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Okay, so let's get to the post-game chart deck. Now, listeners, you'll find the download link to the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Eric Peters' picture that says, looking for the downloads. Now, joining us here is Nick. Now, Nick, what a crazy reaction to that FOMC.
Yeah, that was something to see. Post-FOMC, that whipsaw was quite a move. I have some levels that I'm watching right now, but first, Eric, perhaps we can get your point of view on this.
I thought the market reaction to Wednesday's FOMC statement and the subsequent about face after Jay Powell said, well, sorry, we only meant what we actually said, not what the market tried to read into it, I thought it was very telling. This week's events just further cement a view in my mind that the market is completely fixated on expectations of a Fed pivot, which lack any basis in reality. The Fed has been clear that they hope to slow down the pace of rate hikes when conditions warrant. That means when inflation comes under control. So if you share my view that inflation will be persistent, there's just no good reason to be anticipating a dovish Fed pivot or even a Fed pause. But that still seems to be what markets are obsessed with, even in the wake of this week's events. Bottom line, if I have the inflation thing all wrong, then yeah, sure, the Fed will pivot and markets will scream higher just as soon as inflation comes under control. But if I'm right about inflation remaining persistent, there's just no sane reason for all this pivot expectation mania. And at some point, the market is going to price that reality in, and we're going to see a big move down. And it won't be pretty when that happens. Now, obviously, that's strongly at odds with everything that I said last week about my expectation that maybe the rally that we were starting to see was going to flourish and continue all the way through year end. Well, the facts change. I changed my opinion. In this case, I think that the market has finally woken up this week to the Fed telling them again that there's no reason to be expecting a pivot. Now, if we get back into everybody expecting a pivot, there is room for this to turn around and for the rally to continue through the year end for all of the reasons that I described last week. But I think this may have been a big enough wake-up call to change that direction. It'll be very interesting to see what the next few days reveal. And certainly if we get to new lows below 3,500, I think it's a pretty strong sign that we're headed considerably lower than that.
Yeah, it's amazing, Eric, how that has completely changed just through one FOMC meeting. Anyway, Nick, you were saying you were watching some of these levels. What's your thinking here?
Well, looking at the longer-term time frames, we're seeing significant support, obviously, at 3,500 roughly on SPX, and resistance high at 3,900 roughly. I'm looking at the November 9th OPEX. The reason being, obviously, is that encapsulates the November 8th midterm elections. And current spot, as I speak, is 37.40. The straddle cost right now is about 110 on SPX, which denotes about a 3% move by November 9th. So the upper expected move is around 38.50, which we hit yesterday, obviously. And the lower expected move is around 36.30, which is just above the support of 3,600 and the very strong support of 3,500. Now, obviously, these levels could be tested in the same week at the high and the low based on what happens. But I think that the Fed obviously doesn't want markets to rise, hence why we had the discussion yesterday on further rate increases, because obviously markets rising is inflationary. And you really need to be a market historian with a malleable mentality to succeed in the markets, studying the past, but also ascertaining the differences in current macro climates. And so analyzing the past, we can look at what happened prior to the midterm elections as well as what happened after those elections. And so seeing that since 1946, in the last 19 midterm elections, 17 of those events resulted in higher market performance in the 6 months following the election. It's pretty interesting because analyzing why that occurred, typically was because we saw higher spending as a result of regime change, perhaps. And that may not be the case in this high inflationary environment. But what are your thoughts here, Patrick?
Well, you know what? That S&P 500 went right up to that 3,900 to 4,000 target zone. That's where our Fibonacci zones were. And a typical market reaction from a very oversold condition would typically retrace to those types of zones. And I was really a bit surprised by the hawkishness of the FOMC, not because it wasn't a possibility, but rather I didn't think they were going to do it before the elections. I thought this kind of a hawkish statement could be far more likely in December, and if they came far more in line, that's where there would have been room for the S&P to try to take a stab over 4,000. But clearly, this tone that Powell took has really shaken the markets, and the rejection here just above 3,900 and rollover is a red flag. Now, while the S&P has not yet broken below 3,700, a level which I'm watching very closely, the issue is the NASDAQ has totally broken down. And while we have not seen the NASDAQ break to a lower low yet, the fact that the FANG stocks are screaming lower, many gaps to the downside, the big leadership and generals in that market are getting hammered. And so you take the wind out of the sails of sectors like the financials and other things that were really counting on the Fed kind of easing here a little bit. We could, and the market can be quite vulnerable here. Now, while you're absolutely right that 3,500 is a level to watch, especially since it was where the previous lows were along in October, but this pattern of lower highs and lower lows and bear market price action has not been violated. And if this rejection in any way leads to an S&P breaking below 3,700, while 3,500 will be the first target zone, we might finally see that sell-off that heads all the way down to 32 to 3,400. I'll say while I'm making that forecast, it's not what I originally thought was going to play out. And the fact that this is happening pre-elections just makes me kind of scratch my head as to is this really a scenario that's going to happen here in the week to come? Maybe the market settles in here for the jobs numbers and the elections, and then the move happens post-election. But right now, it's a market that has failed at key levels and remains rather weak.
There's a saying I've been hearing, Patrick, and it's that the generals are the last to be shot. And looking at the FANG man names, we're seeing a lot of them collapse down below support levels we haven't seen in many years. And there's still a lot of downside in certain names, like Google, for example. You look at the price it was trading at in 2020, and it's still far off that level right now. Meta has, fallen drastically in the last week or so from, $137 down to $90 as we speak or so. And Amazon has broken key support levels too. So if Apple and Microsoft keep breaking down, the market could easily fall, I would say probably 10% more or so from here. That's just my point of view.
Yeah. Well, what's also interesting, Nick, I actually expected on such a clear reversal in the markets that there would be a bigger reaction to the VIX. On page 3, I have the volatility index chart, and it didn't seem to at least initially react with any big spike. We're sitting at 26, which is still an elevated level of volatility. But for me, I think the market shows signs of true nervousness when we're north of 30, and we're still not there. What do you taking away from the VIX?
Well, looking at the VIX right now, on the 3-month time frame hourly chart, I'm seeing that we're near support at around 25-ish. And if we turn back up toward 30, that's where things can get really ugly, because obviously yesterday, initially post the 2 p.m. minutes, we saw the market kind of stagnate, then rise gradually, which caused the VIX to plummet. And then we sold off after Powell's comments, and that caused the VIX to also decline gradually as well, which is very intriguing. So right now, given the current levels 26, we expect about 1.7, 1.8% moves each day in broad markets. But it'll be curious to see if we break above 30 again in the short term, because we haven't seen a lot of those crazy 2, 3, 4% down days that we saw back in 2020. And if those start coming our way, we could see the VIX spike to 35 and above in short order. Obviously, the elections will play a lot into that next week, depending on what happens. Now, Eric, on page 4, we have the dollar index. What are your thoughts over here?
We've moved from a global economy threatening uptrend on the Dixie to a sideways consolidation, but there's no reason to conclude that a trend reversal has occurred, at least not yet. The chart is an easy read with the consolidation neatly confined between 110 and 114 on the Dixie. Until we see a sustained move outside that range, we're consolidating sideways. End of story, and there's no reason to conclude that the trend has reversed.
Yeah, Eric, I'll have to say that the Dixie and the dollar index reaction to that hawkish Fed really actually I think is a true advertisement of what's in store for the broader intermarkets. One of the whole themes I had was that, well, if we had a short to intermediate swing high in the dollar, maybe the dollar put in a high for the year, not necessarily the end of the major trend, but simply just a pause, then that would have allowed all risk assets to, be able to take a breath and continue, a year-end rally of some sort. But the hawkishness of the Fed has really sent that dollar index screaming higher, and we're above what I was watching, a key level around 112. I mean, at this stage, obviously, all those major highs are near 114. But boy, is it really just look like that dominant US dollar trend remains intact. At this moment, every dip gets bought. The dollar index goes screaming higher. But in this case, almost every cross currency against that US dollar is getting hammered. The euro is down towards 97 cents. The pound sterling rolling over again. But the one that I'm watching on page 5 is what's going on in that US dollar yen, because we had two direct interventions by the Bank of Japan to try to stabilize the currency. And while it paused the US dollar advance, it really certainly has not reversed the trend. And if right now this the hawkishness Fed and higher interest rates in the US is now being priced in, what if this sends that US dollar yen to a fresh new high? I mean, now we could see 155, 158, and I think that there's a lot of macro traders that have been trying to already be playing the story that the US dollar yen is at least the yen is super cheap, and yet we see this Canadian dollar rolling, Australian dollar rolling over. Everything is just getting hammered here, and if that U.S. dollar strength persists, it's really going to be a drag on risk assets.
Yeah, Patrick, I definitely agree with that assessment. I was looking at the Bank of Canada last week raising their rates by 50 pips and thinking that if the Fed raised by 75, that it would be insufficient in keeping their dollar at the current levels. And I guess I was correct in that assessment. But on slide 6 over here, we have crude oil. Now, Patrick, what are you seeing here?
Well, you know what, Eric, you were talking about that 200-day moving average, and I just thought it would be relevant to show it on the chart here. And it really is depicting a very important line in the sand in terms of the bull and bear trend. What's interesting is that in a lot of risk assets turned decisively on the Fed, and oil paused, but it hasn't broken in any way. I'll agree with your assessment. A clearing of 90 is incredibly important, even if that moving average wasn't there. The reality is that since June, we've been in a sequence of lower highs and lower lows and predominant weakness in distribution. But what we've seen really in the month of October is an SPR release, an attempt to talk oil prices down, and yet oil has crawled higher and not making lower lows, and really to decisively change the trend, to really get trend followers to start piling into the oil trade. That break of 90 will be a true advertisement that oil has begun some sort of a new bull leg. So watching that into next week is something that's certainly on my mind. I wanted to move on here to page 7, and I'm looking here at this gold chart, and I'll stand by my view here, which is that while a lot of people are looking at real rates and other variables, to me, gold has really just been acting like a cross currency to that U.S. dollar, and with that U.S. dollar ripping higher at this juncture, it just dragged gold down. But what we have seen consistently since the downtrend started in March is that sequence of lower highs and lower lows in a very distinctly downwards channel. And as we approach all of these previous lows, gold here is quite vulnerable to still having one more leg down. And while I think the majority of the gold sell-off may be rear view mirror, it doesn't mean that a new uptrend or even a bottoming formation has even begun. If the breakout in the Dixie really does continue, the vulnerability of gold breaking to 1550 to 1600 is the most immediate path of least resistance. At some point, there's going to be a great buy on dip here, but boy, the price action just still looks incredibly weak.
Yeah, Patrick, I definitely agree with your assessment on gold. If it breaks down below 1600, we could see some more downside. But I want your opinion on uranium over here on page 8.
Yeah, obviously we're tracking here with that Uranium Trust. The one commodity that has generally been behaving quite bullishly since bottoming back in the summer has been uranium. It's really shifted to the sequence of making higher highs and higher lows. And we, after having this test of the $18 level on this trust unit, are in the midst of a pause and a consolidation. One thing that I'm completely focused on here is whether the pattern of dips being bought persists, which is, let's say we have a quick dip down towards 16.5, which is a very typical retracement. It'll be really interesting to see how quickly the buy on dip traders take advantage of that. A typical behavior that we would see is very similar to what we saw in late September and early October, which is once the price gets hammered for 1 or 2 days, almost immediately the buy and dip traders have a catalyst to immediately start buying and turning it. And it'll be really interesting to see if that emerges after this consolidation.
Yeah, Patrick, we can't really wrap up without touching on the 10-year government yields after that FOMC and that sharp rise we had yesterday. Now, what are your thoughts here?
Well, look, I think everyone was already starting to entertain the idea that there was going to be a dovish tilt and that there was going to be an advertisement that the rate hike cycle may be coming to an end. And when the hawkish tone really came out, everyone's starting to realize that more interest rate hikes are coming, and the bond market just immediately took it very poorly. Now, with yields staying decisively above 4% on the 10-year yields, it really continues to demonstrate the weak state of the bond markets. So they're all a stone's throw from fresh new lows. Yield curves continue to stay inverted in many places, and it's just a condition that is incredibly weak. And if we see the yields break to higher highs in this sequence in any way, that just is going to be compiled with the dollar strength, and it's just going to drive further risk off. I am a little surprised that this is happening right before the elections, but this is just simply it continues to be a scenario where the prevailing trends that have been dominant throughout the year are still the trends that are intact, and it's going to certainly feel like a lot more of this continuation moving forward.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.